I tell people that I bleed local government, so when the General Assembly or other folks are doing things that I think are detrimental to counties, to local government, it hurts. And sometimes I get mad. But I'm not here to talk about that today. Today, I'm here to talk about the local income tax. So how many of you are brand new to county government or will be in January? Oh, a great many of you. Well, welcome. This is going to be fun. You're going to enjoy it. So we're going to talk about understanding the local income tax, which is also known as LIT. LIT was the consolidation of three existing county-level income taxes. The county adjusted gross income tax, which was authorized in 1973. Then the county option income tax, which was authorized in 1984. And then finally, the county economic development income tax in 1987. And although it's referred to as a single consolidated tax, it really consists of, for all 92 counties, it can consist of 2 rates. And in some counties, it will consist of 3 rates. And there's a property tax relief rate that nearly every county's imposed, an expenditure rate, which is the money that you're going to spend, and then a special purpose rate. On the property tax relief rate, the maximum rate at which it may be imposed is 1.25%, and the revenue is used exclusively to reduce property taxes. It can be a credit applied to homesteads, to residential property, and to non-residential property. The expenditure rate, which is the one I think that we'll probably spend the most time on, and I think that's what Herschel and Tim will spend the most time chatting about, is the spendable money. The maximum rate for the expenditure rate for 91 counties is 2.5%. For Marion County, it's 2.75%. In addition to that, in last session, the General Assembly authorized each county to impose an additional expenditure rate of up to 0.2% for a period not to exceed 20 years to pay for jails or rehabilitation facilities. Revenue from that rate has to be, I'll say, taken off the top before the revenue is distributed to the rest of the units in the county. The purposes for which the expenditure rate may be used, and it's not just county money. I mean, those of you who are familiar with the former statutes know that a portion of the revenues flow to other civil taxing units in the county. So in counties that were formerly CADGET counties, 0.25% off the top is dedicated to property tax replacement credits, and this will go to schools. This is the only local income tax revenue that will automatically flow to schools. The other purposes, then you've got it's all the rest of it's treated as additional revenue, and it may be used for public safety expenditures, for economic development, and then the remaining is called certified shares. The special purpose rate, which is not available in every county, authorizes specific, there are 28 or 29 of them now, authorize individual counties to enact an additional rate of tax. And most of those projects, well, all of them are capital in nature, jails, courthouses, juvenile detention centers. This is something Herschel and Tim will talk more about. The maximum rate for those varies. I think the highest one is probably 0.75%, and the lowest one is probably 0.2. So implementing the local income tax. If you were a former CADGET county, the county council is the adopting body, the entity that has the responsibility for making decisions about the income tax. revenues. If you were a former county option income tax county, then it's the county income tax council. So the defined term is adopting body, and it varies for almost everything but two different rates, and I'll explain that in a bit. So the county adopting body has the authority to adopt an ordinance to impose, increase any one of these, the expenditure rate, the property tax relief rate. For the expenditure rate, the ordinance takes effect, if you adopt it before September 1, it takes place 2 months later, on October 1st. If you adopt between October 1st and November 1st, then it's January 1, the immediately succeeding January 1. So if you adopted it this year, it would have taken place January 1. And then if you are later than that, then you have to wait a whole year before you see any revenue. The tax doesn't take effect for a whole nother year. You can also change the property tax credits, either the amount or the way in which you distribute the revenue from the property tax relief rate. Again, if it's adopted between January 1 and November 1, it takes immediately effect, that January 1. And if you're later than that, then you've got to wait another whole year. That's similar to the wheel tax, which some of you may get exposed to at some point. The county adopting body can adopt ordinances that grant or change the allocation of the expenditure rate revenues. Again, if it's adopted between January 1 and November 1, it takes effect January 1 of the immediately succeeding year, and if you're later than that, then you've got to wait another year. And we've already talked about the adopting body being either the county council or the county income tax council. County council is easy. That's what all of you are about to become, members of a county council. The income tax council is allocated a total of 100 votes, and it consists of the members of the county fiscal body, or it consists of the county fiscal body and the fiscal bodies of each municipality in the county. And votes are allocated on a population basis, and the county's population, the population attributed to the county is the unincorporated areas of the county. So in some places where there's a local income tax council, the county council may have more than 50 of the votes and therefore makes the decision. In other counties, it may take the county council plus a municipality to take any action on the income tax. In some counties, one municipality controls the decision, and in other counties, 2 or 3 municipalities can control the decision. Before July 1 of each year, the Department of Local Government Finance is required to provide to each county and the county auditor an estimate, and it is just an estimate at that point, of the estimated lit revenues for the succeeding calendar year. And they have to, the DLGF identifies how much revenue will be provided for property tax credits, how much will be public safety revenue, school distributions, economic development, and certified shares. Once the county auditor receives it, he or she has 30 days to tell each of the taxing units what the estimate is for their specific amount of revenue. In 2016, when the statutes were originally consolidated, the DLGF looked at the 3 different taxes, or 3 different purposes within those taxes, and said, okay, they've got a seeded rate of 0.5, so that's what we're just going to say is their rate going forward. And so in 2017 and probably in 2018, generally speaking, whatever was in effect before the lit change was the same revenue allocation. Before October 1 of a year, the state budget agency is supposed to certify to the DLGF the estimate, or more or less we promise this is the amount of revenue you're going to receive from income taxes in the next calendar year. And that goes to the DLGF and to the county auditor. And then the county auditor, within 15 days, is required to tell all of the taxing units, okay, here's your final breakdown. Now, the statute has a couple of mechanisms for giving you additional distributions if the state got the numbers too low, and for requiring you to pay back if they gave you too much money. Is there, from what? No, there's no appeal. Once the Department of Local Government certifies the number, that's what you're stuck with.
It's based on your adjusted gross income of taxpayers.
And what was actually reported on.
On your income taxes, so it wouldn't be more of an appeal, it's just more of an indication of, gives you a good baseline of what the revenues are coming in, and then for future purposes, so it's basically based off the adjusted gross income.
And what was actually reported. And the state has a trust account for each county into which the revenues received under a tax return is placed for each county. And so I don't know that they do it. I know they don't do it every year, but every few years, the state goes and takes a look and says, oh, you have too much money sitting in your trust account, because there's now a requirement that only a certain amount can be held by the state, and so then you'll get an additional distribution. And in some cases, and back in 2017, when they did all of the road funding, the state said, we're going to give all of you some of your income tax that you've already imposed, but you have to use it for roads. So the state is supreme. They can make whatever decisions they want. Expenditure rate revenues. In counties that were formerly COIT counties, if there's no expenditure rate revenue that's been allocated to public safety answering point, which another one of those buzzwords you're going to get familiar with, also known as a PSAP, the county council, notwithstanding the fact that the income tax council makes the decisions, the county council may on its own adopt an ordinance to implement an additional rate of lit not to exceed 0.1% that has to be dedicated solely to the public safety answering point. And then, as I mentioned briefly, there's an additional 0.2% that can be imposed for up to 20 years for jails and rehabilitation facilities. Those revenues from those two taxes are supposed to be distributed off the top. So if the auditor is told there's $20 million coming to the county as a whole, whatever represents the PSAP and the correctional facilities and rehabilitation facilities rate, that revenue comes off the top. And the next thing that comes off is, if you're in a Cadgy County, is the 0.25% that gets distributed to all taxing units to help replace property taxes. Everything else that's left is expenditure rate revenue. Each year, the adopting body is supposed to adopt an ordinance allocating the expenditure rate revenue among three purposes: the public safety, the economic development, and certified shares. That ordinance remains in effect until it's rescinded. If you don't adopt an ordinance, you're going to be stuck with last year's rate or allocation, whatever that was, and I think that's been okay for most counties so far. There are a couple of caveats here, and these are very important to financing, is that when the adopting body is deciding, well, maybe we don't want to give 0.5% of revenues to economic development, we want we want to put it all in public safety. If anybody in the county has bonds or leases that are outstanding, the adopting body can't do that. They're not allowed to change the proportional allocation among those uses if anybody's got bonds or leases outstanding. Now, how's the adopting body going to know that? Well, there's no required way for them to know. But the statute now says that to better inform the adopting body, any of these entities that have got bonds or leases outstanding need to give that information to the adopting body before it makes a determination about allocation. And it has to be provided before the date of the public hearing that must be held on the allocation ordinance. Public safety revenue, I'm sorry, I didn't mean to do that, is allocated to the county and to each municipality in the county that performs one or more public safety functions or carries out at least one public safety purpose. So the county is likely to get some because of the jail and because of the courts. Municipalities will probably get revenues because they're providing fire protection or police protection. Townships are not automatically entitled to public safety revenue. No, they're not automatically entitled either. They can come and ask for it. They can go to the adopting body before September 1 of a year and ask to receive a distribution, but they're not automatically entitled to any of. Got a question? There's nothing in the statute that limits it. It's up to the adopting body to determine the dollar amount and if they're going to do it at all. Yeah. Yeah. And then revenue, again, we've already talked about it. Revenue dedicated to a PSAP has to be sent to the PSAP before any of the rest of the public safety revenue or expenditure rate revenue allocated to public safety is flowing on down. Economic development allocation. This is distributed to each of the civil taxing units, and I should say that is also true of the public safety rate. Schools don't get it. Civil taxing units on the basis, it can either be pro rata property tax or it can be on a population basis. The original statutes all provided that the total county property tax levy was then was the denominator, and the numerator is like the counties as the county units property tax levy and that's how the allocation or the distribution of economic development revenue is done. However, it is possible, if the adopting body wants to change that allocation from relative property tax levies to population. And I know of at least one county that did that many years ago. So their income taxes are distributed on the basis of, those income taxes are distributed on the basis of population. Each civil taxing unit that is going to receive economic development allocation revenues may either adopt a capital improvement plan or they can designate another taxing unit in the county to receive all or a portion of their economic development allocation. Certified shares are also distributed to civil taxing units on the basis of, this is after you've done these other two, on the basis of population or relative property tax levies. Special purpose rate revenues. We've kind of talked about this already. In addition to the capital specific rates, the statute authorizes a county that is a member of a regional development authority to adopt an additional rate of income tax that is dedicated solely to the regional development authority and is used for projects of the regional development authority. And that's the end of it. Yeah, I'll take a couple questions real quick, then I'll turn it over to Tim and Herschel, and then we'll wrap up.
What is the definition or what is a certified share?
The certified share, the income tax is a big bucket, and the expenditure rate is a big bucket. I'm going to ignore the others at this point. And a portion of the county, the adopting body may choose to allocate a portion of that revenue to public safety. It may then say, I want to allocate some to economic development. Once those two are done, whatever's left is a certified share.
Yeah, so, so look at certified shares.
I don't know where that term was actually came from the original Cadget statute, so it probably meant something in 1973.
I guess they certify our shares out to us.
Yeah.